We've got multiple stock indexes at all-time highs. Here's a headline I saw last week. S&P 500, NASDAQ, Dow, and Russell 2000 hit records. When you see these types of headlines, you'd be forgiven for having some questions or concerns about the near to intermediate term outlook for stocks. For all, it's been an exceptionally good run for stocks the past several years. To really drive this point home, let's quickly revisit the annualized returns of large cap US stocks in recent years. And we'll use the S&P 500 index here. Over the past year, the index is up 19%. Over the past 3 years, the index has averaged 23% per year. Over the past 5 years, 17% per year. And over the past 10 years, 15% per year. Now consider those returns in the context of the long-term average return on US stocks of about 10%. And you might be wondering if a reversion to the mean is in store. I certainly am, but allow me to offer a counterpoint of sorts. And this might be surprising coming from me because I've been accused of thinking there's boogeyman around every quarter on occasion, but I've got 2 charts for you here. This first chart is from JP Morgan, and it shows the average future returns under 2 scenarios. One is from buying stocks on any day, and the other is from buying stocks on days when a new all-time high is set. This data set spans 37 years from 1988 through 2024. Now let's look at the 3-month period first. According to this chart, if you had invested in stocks on any day, you would have averaged a 3% return over the subsequent 3 months. But if you had invested on days when new all-time highs were set, you would have averaged a lower return of 2.4% over the subsequent 3 months. This makes sense. Now let's go out to 5 years. This is where my head starts to spin a little bit. If you had invested in stocks on any day, you would have averaged a cumulative return of nearly 75%. But if you had invested on days when new all-time highs were set, you would have averaged a cumulative return of 81% over the subsequent 5 years. Think about that for a second. This second chart is from Dimensional Fund Advisors and is a slightly different spin on the same story. In this case, the data extends all the way from 1926 to 2022, and the returns are annualized for all periods presented, not cumulative like in previous chart. So let's jump ahead to 5 years later. It shows a negligible difference in returns from buying stocks at all-time highs versus at any other time. 10.2% versus 10.3%. Okay, so these charts are thought-provoking and might even seem counterintuitive. I think we can break something like this down into emotions and statistics. Emotionally, the market at an all-time high, it feels dangerous. However, statistically, market highs are essentially no more dangerous than any other entry points along the way over long stretches of time. Now, I think that message is comforting. But if the time horizon for your investment portfolio or a portion of your investment portfolio has shortened for any reason, maybe you've decided to buy a vacation house in the next few years, or you are mid-retirement and you've been thinking about reducing the risk of your portfolio, those might be reasons that you could justify cutting the equity allocation at today's record stock levels. If you think something like this applies to you, I'd be happy to discuss. Otherwise, thank you for watching. I'll see you in October.